We're going to be talking about the discipline dilemma, sticking to your plan without becoming too rigid. Oh, I really thought about doing this one. I thought, oh man, am I right to do this? Is this opening a can of worms? But hey, do you know what? This is probably more intermediate advanced, right? If you're and I think I'm not sure if I mentioned this, maybe I'll repeat myself, but I'll skip over if I do. If you are starting out in trading, if you are new to trading, you absolutely have to dial in your discipline and just be very focused on doing one job. Like, okay, if this is happening, then I'm going to pull the trigger, and sticking to that. So this is really when you get to a level where you've got some experience in the markets, intermediate, advanced, however you want to frame that, where you kind of recognize that actually you don't want to become shackled by rules that you become a human algorithm, but at the same time you don't want to be wild man just shooting from the hip and hoping things work. Okay, so we want that sweet spot. So today, hopefully, I'm going to share some stuff that will be relevant for you to really think more deeply about this conundrum, but without going too far and being completely poorly disciplined. Because I don't want everyone to go, oh, well, I heard on this guy say on the webinar that actually, maybe I should be a little bit more flexible. No. If you're struggling with discipline, you absolutely should just nail that down. But if you think like you've got some control of your discipline, you're following your plan, we want to get to an intermediate advanced stage where we're able to adapt to the conditions in front of us, able to adjust, able to make those minor on the fly decisions that aren't crucial, aren't critical, but allow us to blend in with the current market environment, because the current market environment presents something different each day, right? Okay, so of course, I just remind you, I'll keep it brief. Please understand that trading spread bets and CFDs is a risky business to get involved in. Leverage comes as a double-edged sword. It works absolutely fantastic when it's working well, but if you were long from early morning today with leverage, you were getting stung. If you're talking about Nasdaq, that is. If you were short, you make a good profit, but just understand the balance that comes with trading with leverage. If you don't understand how to trade, please don't trade. Please just go and mess around with demo, work out how to manage your risk, work out all this other good stuff. And the reason I label this point is, number one, obviously we're obliged to, but number two, I really hate to hear stories of traders who didn't really know the risk they were taking and kind of didn't really understand what they were doing. So, if you are brand new here, I know most of you are intermediate advanced, so fine, you understand the nature of all this. But if you are new, you've stumbled across this somewhere, then please do your own due diligence. Okay, quick reminder. My name is Mark Holstead, by the way, for those of you who don't know me. I run Traders Mastermind, trading for 20-something odd years. 2001 I started. I've got a lot of experience in the market, sure, but I don't have all the answers. I always say this because I want to get this out there and say I don't claim to know everything, but I try to share with you what I think is valuable. I try to share with you what I see from others by running a trading community. People, something works for one, doesn't work for another, and share all these ideas and thoughts and mash it all together and put it into something that's reasonably coherent, so you guys can go away from the webinar and say, you know what, I learned something there, and that's going to improve my trading. If you improve your trading by 1%, then that's my job done. If it's 10%, then that's a fantastic job, because how many webinars you got to go to at 10% to really do a better job? So like I say, I think I'm in quite a unique position to share my thoughts and ideas, experience, and observing others. So I do exactly that, and I try and share what I think is valuable. One of the things to say is, often people say they tried something, didn't work. I always say this, and I know if you've been here multiple times, maybe this gets a bit boring for you, but I'd say it with purpose, is that, when it applies to everybody, when making a change, whether it's a slight adjustment to the plan that we're going to talk about today, slight little operational consideration, strategy consideration, technical adjustment to the strategy, just take your time, run with it for a bit, observe the change, stick to it, and then audit the performance, and then make a course correction if required, as opposed to constantly making massive adjustments. And that's going to be quite apt for today as well. Okay, so last time, if you were here and you joined me last time, it was a pleasure to have you here. Thank you so much. And by the way, thank you for coming on live. Those of you who are here live, I appreciate that. I appreciate having this feedback. I appreciate knowing that there is a selection of you looking and observing, and hopefully I'm going to give you as much value as possible. We will do a Q&A at the end if you want to stay and you want to have a question for me. If I can answer it, I certainly will. So I appreciate you coming on. Thank you. And if you're watching the recording, that's fine too. But it's a certain energy here when I know there's people watching. So last time we talked about filtering out market noise and focusing on high probability setups. And that was really decluttering your environment here. That was really making sure that your office was in a good situation, clear, making sure that your screens didn't have any excess noise on, which were the basics, which I felt like I had to cover. And then it was, what are we looking at to make the decision? How are we kind to make the optimal decision without looking at things that actually don't move the needle or aren't that important? All right, so it was clear signals, zero distraction, making sure we weren't getting bombarded with news and opinion, all that other good stuff, and implementing like a filtering process to improve that trade quality. And we'll leverage more on that today, and you will see how we start to develop a system, an approach that's unique to you. And again, we're not here to kind of prescribe a specific methodology. We do talk about strategies at some point, but it's more to get the clarity and feel comfortable. As a side note, when I see traders who kind of come up through the ranks, so to speak, and doing well and starting to do well, one thing that stands out is they have a very clear approach. They have confidence in the approach, and they don't fear the outcome. They don't fear anything unusual happening. And I think in the early days as a trader, you fear it a bit because you think, oh, what if I lose? What if I go on tilt? What if my discipline slips? So it's important to kind of get that completely dialed in. Okay, so let's get straight to it. The discipline paradox. Why this is a double-edged sword? Because, and again, I'll finally say this. Hopefully I won't say it again, but this is not for brand new beginners. If you are a brand new beginner, that's going to be a beginner, right? If you're brand new to trading or a beginner, please, the discipline is absolutely paramount. It's absolutely crucial. Getting involved in little tiny things here and discretion here and there, no. At some point in the future, this is what we blend into it now. We're going to talk about now for intermediate advanced stuff. But if you're brand new to trading, your discipline must be on point. You have a plan, you stick to it, you prove you can stick to it, and you earn the right then to add some discretion and some flexibility into your decision making because you've proven that you can stick to the rules. So I won't say that again, but it's an important note. Discipline is crucial, right? It's essential. And without it, we're just going to get nowhere. So, but if we have too much, the problem we have is that we're quite late to adjust and adapt. And I'm going to kind of cover sort of on the fly decisions today, what I consider acceptable on the fly decisions, and also some adjustments and course corrections you make to your plan at kind of incremental pass through your journey. We need to find, and the ultimate goal here is, and this is a difficult one, and I really kind of thought twice about doing this and thought, but you know what? There are traders out there who are going to appreciate this. The traders out there are going to understand the concept here. And I think for many of you, a light bulb will go off and go, actually, yeah, it's not so black and white. We hear about sticking to your rules, sticking to your plan. You've got to do this, got to do that. And fine, we do. But there's a certain point where it's not quite as clear cut. There's that gray area, as there always is with trading, that we need to appreciate and accept as traders, that we need to embrace, because that's where edge is. Edge is in the gray, especially as a human trader, a trader trading with experience, as traders trading with some intuitive abilities. Then we need that, and we need that. All right, so let's find that balance today between control and flexibility. And the goal is to follow your plan, but to be able to evolve and adjust and adapt. Not too much. We'll talk about this. Not too much where you're chasing your tail. Not too little where you're always behind the curve. And maybe you feel like that, right? Maybe you feel like that where you feel like, hang on a second, I'm always late. I'm always kind of getting involved in a trend when it starts to peter out. And then when it starts to kind of chop in, I'm trying to trade mean reversion, it shifts to a trend. And I always feel like I'm behind the curve. I always feel like I'm just missing the wave. And this might solve that for you, because having the autonomy to be a little bit more flexible with your discipline can really open a lot of doors, especially if you're controlled with it. Okay, so are you too rigid or too flexible? So something to think about here as I kind of talk about this is, which one describes you best? So traders typically fall into a couple of these categories, right? You're either an over adapter and you're constantly tweaking your strategy out of fear or impulse. And what I mean by that is, and maybe a bit of both, but where you are now is kind of a good thing to think about. You trade something, you go, oh, I got stopped out on there. Maybe I need to widen the stop. Oh, I want to wait for the bar close. Oh, that's too high. I'm going to just wait for the cross of this level. You know what I mean? Constantly adjusting and adapting And I say out of fear or impulse here, and they're quite emotive words. I appreciate that. But, if you think about why you're doing that, ultimately it is because you've not necessarily, oh, I'm scared. It's more a case of, I don't want to miss this trade. I don't want to miss the move. And it's that fear. And I know it's a funny word, fear, because, you think of fear like a guy with a shotgun to your head. You're like, yeah, okay, that's probably going to be a little bit frightening, but markets shouldn't be frightening. But it's the fear of the outcome. So we've got to make sure we understand what we mean and define that. Or it's impulse, where you think, I'll just change something. Or you're too rigid or over rigid, refusing to adjust even when conditions shift. Now, I will say this, okay, and I said I wouldn't say this, but I'm going to change it slightly. It's good to be disciplined, but at some point, once you've proven you can be disciplined, now's the time to be flexible. I know that sounds like an absolute ridiculous politician thing to say, but it is the case. It's like you prove the discipline, then you unlock the ability to have some flexibility. I hope that makes sense. Because if we're over rigid and we're just do this, do that, do the other, that's great to get you to level 1, but to get to level 2, 3, 4, 5, 10, 20, 50, you have to be able to be a little bit more dynamic with it. But of course, getting to level 1 is important too. And we don't want to turn into human algos, right? We're not very good algos. We need the toilet, we need sleep, we make mistakes. We're pretty rubbish when it comes to algos. Now, in a few years' time, we'll all be buying Tesla robots that can sit here for us and execute our trades, which will be fine, right? You've got an algo there. But in the meantime, let's use our human intuition, experience, and judgment to be able to make those on-the-fly decisions within the boundaries of allowance, if you like. And let me just talk on this for a moment. When I see a lot of traders, right, this is how I believe traders' decision-making process should be. Brand new, you go from here to trade, and it should be very, very systematic, methodical. If this, then that. If price is here, then do this, right? There's no ambiguity to it. My stop loss is X, my target is X, my size is X, my risk is X, click, and you get better. Then as you evolve as a trader, that little chunk at the end grows and there's a little bit of discretion. And maybe you say, you know what? I'm going to decide whether to take the trade on the bar close or take the trade on the bar crossing a level, right? So there's a little bit of discretion. And then fast forward to a trader who's very experienced. There's a lot more discretion because you kind of know what you're doing anyway in terms of what I'm trying to achieve. I'm trying to achieve this. I'm trying to do this. I've got these strategies and methodologies, and you've got a broad kind of approach, but there's enough flexibility. You know you're not going to go on tilt, but the rules are, hey, I'm not going to risk more than X on this. This is my allowance for risk. And so that flexibility becomes more, but you've earned the right to make a little bit more on the fly decision making, not necessarily on the flies and last minute, but adjust based on the conditions, as opposed to sticking to the rules. An example might be, you've got some examples at the moment, but example might be, let's say the market's kind of running really hard to the downside and you've got a level there and your strategy says, hey, if we pin bar through that level, then I'm going to take it with a stop below that low, right? And that's a feasible strategy, but you see it motoring down really on fast at the open. And you go, you know what? This looks heavy. This looks like we're just getting started here. I don't like it. For whatever reason, you make that judgment. This is why experience is very, very important. You can't make that judgment when you're a beginner. Then you say, okay, I'm going to give it a bit of time. Let me just give it another 5 minutes, another hour, whatever it is. Let me see where we are at European close or whatever market you're trading. And that is experiences because there's something different happening now. The move looks heavy. There's a lot of volume coming in. You can see some of the markets you're tracking correlate. You just know there's so many variables that you're taking in and perceiving very, very differently. So, that might be sort of something, a good example. And so think about now, what John describes you best? Are you really rigid or are you constantly being flexible? Well, do you think you've got a sweet spot? Because you've got a sweet spot, that's the place we want to be. And we don't want to be other side, as in always in trading. We want that balance right in the middle. And listen, this isn't fixed. Just like, there's a lot of things in trading aren't fixed, like your emotional state. Sometimes euphoric, sometimes fear. You want to kind of balance it. And it's never fixed. It's dynamic in terms of sometimes you might feel like you're constantly changing and because of fear or because of prior performance. And sometimes you might be like, I'm going to stick to the rules. And it's okay to adjust and adapt, but it's also good to kind of audit where you are at that moment in time. Okay, so thinking about that, think about, when discipline becomes a weakness. And again, the title's a little bit of a just probing a touch because I think it can never be It can never be a weakness because you can be disciplined, but also disciplined to say that I'm flexible, right? Flexibility is still discipline as well, but I think you get what I mean by this. So sticking to the plan is good, right? Until it ignores the market context. An example there, if you're just buying into, I always buy pin bars on flushes. Well, the other day when the Nasdaq was falling through the floor, you'd have got your face ripped off, and it wouldn't have worked, right? And sometimes you can't plan for every eventuality in the market. Maybe you can, but you need to be able to adjust and adapt. And situational awareness and understanding the market regime and where we are and the conditions, because you and I both know that things change very, very quickly. And it's a great example now with the US equity markets, or even the European, to be honest, with the DAX flying based on the amount of money they're spending, all this type of stuff. Or you're trading Tesla, you're trading Bitcoin. It's a big shift in sentiment, right? And will it shift back? At some point, I'm sure it will. But at the moment, we're in a situation where things are very, very different to they were at the beginning of the year. They're very different to at the end of the year. And understanding that and being aware that your job as a trader is to be very, very aware of the conditions, very aware of the psychology of the other participants, very aware of what is driving the market that you're trading right now, what could change that sentiment, what could shift, who's trapped, who's not trapped, and understanding all this and taking all these nuances is something that's very difficult to always work out an if-then statement. But being really, really self-aware. Even like today, a good example. If it's really, really heavy at the moment. Imagine if it went another same amount and we started taking out the yearly lows. That's not a normal low. There's so much more to that. It's so important because a lot of people have been trapped from yesterday. Blah blah blah. You get the point. There's so much context that's important, and so we want to be able to take advantage of that as traders and be able to put risk capital on and be able to make decisions that are flexible enough because we take the information in and they're sensible decisions. The risk is managed, all the other good stuff is ticked off, but it's like, hey, this is different. Something's changed about this. I need to have a little bit of autonomy to adjust and adapt what I see in front of me. And I can imagine this in the military, right? I've never served in the military, but I can imagine there's a plan. Everyone goes in, but they've got the autonomy to do stuff different. In fact, when I was listening to an interview with the guy who raided the Bin Laden camp, or one of the guys, saying things went wrong. I think the helicopter crashed, all sorts, but they adjusted, they adapted. And I know it's a bit of a make that much sense of analogy, but hopefully knowing when to adjust and adapt is key at any high level, whatever you are at. A better example would be a surgeon, right? Surgeon's going in, he says, I'm going to do this, 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 and this, goes in and sees something different to what he's expecting. What does he do? He doesn't just freeze and carry on regardless. He says, hang on a second, that's in a different position than it should be. Whatever's different with this person, or whatever, or something, I'm not used to seeing this. I need to adjust on the fly. And yes, the operation has a procedure, but he has the autonomy to be able to make a different decision. Okay, so let's talk a little bit about when adaptability becomes a weakness. So we talk about discipline when adaptability becomes we don't be too rigid, we don't be too flexible. Why? Because if we're constantly chasing our tail and adjusting, you're always going to be behind the curve because you're 1 day behind or 1 hour behind or 5 minutes behind or 1 week behind. Yeah. If you're always adjusting and adapting and it doesn't work from a logical perspective, nor does it work from it's just inconsistency. It doesn't work from an operations perspective because you end up not only not being aligned with the regime, or you might get lucky, right? Let's say the regime stays like it is and you adjust very, very quickly, but you have this inconsistency and self-doubt and you never trust what you're doing because if you're constantly adjusting and adapting, you can never believe what you're up to. You're like, hey, I don't believe it because I'm always changing the damn thing. Right, and then you say, and then in your heart, you know that you've adjusted, adapted because you just don't think it's going to work, and you're like, well, I'm going to have to change it again. I'm going to have to change it again. And we talked about this before. The confidence bank needs to be deposits. And when you adjust and adapt, it's like, oh, I think I should change this. You just end up running around like a headless chicken, right? You just listen. We've all been guilty of this on our journey at some point, right? You have multiple losers in a row, and you go, oh God, maybe I need to change something. But the good traders go, okay, well, are those losses just part of the system, or has the regime shifted? And we'll talk about this in a moment, adjusting and adapting. But you just be aware that we don't want to constantly be tweaking stuff. I liken it to like you're driving a car. If you drive the car looking right at the front of the road down the bonnet, you're going to be like this. Every little thing and this, making these adjustments, and you give me anxiety, and it's very, very difficult, right? You might get there, but you're gonna crash at some point. Versus looking as far ahead as possible, and you're headed in the straight line. You're headed around that bend. You're not constantly making adjustments. You're just making little adjustments as needed to navigate the road and the terrain. And it's the same with trading, right? You need to look ahead. You need to make some adjustments, but you're not always yanking the steering wheel, right? I've got my line. I need to tighten it a little bit. Oh, the bend's tightening a little bit. Okay, now I'm coming out. It's much more of a rhythm and a flow, like surfing. And trading should be about that. It's getting to the rhythm and the flow, and not trying to force this binary kind of approach into trading. So just think about the difference between those smart adjustments and emotional reactions, and we'll get to kind of how we frame those in a moment. So the difference between the strategic adjustment, the smart adjustment, and emotional reaction. So a strategic adjustment is just at the beginning slide, second slide in, I said, hey, things take time. That's what I mean by that, is that we run with a different strategy for a while, or a strategy for a while, and we review. And most of the time it's when the market's closed. We're not reviewing too much on the fly, and we're saying, hey, do you know what? I'm a little bit late to things here, or I'm buying dips and it feels like it's too early. It feels like we're heavy. And that might work, but I need support, or whatever it might be. I'm trading mean reversion. We're getting those extra. I'm trying to hold trades to be runners, and I'm just not getting that first target, second target, third target. Okay, well, if that's a pattern, then we go through and we look at the market and we say, have things shifted? Has the ADR, has the typical daily range contracted? Has the rhythm on the daily chart made a complete shift to how it was before? And we make an adjustment based on that. And maybe we say, well, it's a minor adjustment. I just end up taking more of my position off at target 1 versus target 2. I don't look for the runner anymore. You're not massively overhauling what you're doing, but you're just looking where the holes are and making a slight adjustment based on the conditions. And actually, you might be in the situation where, hey, the conditions haven't shifted. Good example would be if you're buying dips on that uptrend we had last year, and you got stopped out a few times on a dip buying strategy where you're buying through the low, coming back up. You wouldn't change it so much. We're still in an uptrend. It's just one of those things. And so that's a strategic review where you don't make any adjustments. Okay, let's look at emotional reactions. And again, we've all been there. We have all been there. We've gone, oh, I'm gonna widen the stop. I'm gonna do this. I'm gonna make sure I change my size. I'm gonna make sure I get in a little bit earlier. And it's a panic and it's an impulsive decision. And that impulsive decision very rarely serves us, because what we tend to do, and this is how the thought process works. Let's say you've been stopped out 4 or 5 times in a row and you're really annoyed. You're like, oh, I'm getting stopped out 4 or 5 times in a row. And you think of something and you go, widen the stop. And you think of one thing and automatically then you reinforce, or you find data to support that impulsive decision, rather than a cool, calm, logical, you're on your whiteboard, you've got a piece of paper, whatever it is, and you brainstorm and workshop through different ways to solve the problem in front of you. You've gone, oh, I'm just going to use a wider stop, right? And you do that and you reinforce, yeah, that'll work. Oh, yeah, I've used a wider stop, I won't get stopped out. That might be the solution. You might stumble across it, but the solution might be you're entering too early. You're misjudging the volatility of the market. You're buying a candle too soon. So the actual solution that would work would be pump the brakes for 5 minutes, wait for the next candle to close, wait for one more sequence. And you wouldn't see that if you were acting emotionally, because you just come up with an idea and you support it with stuff you see on the screen, stuff you see in front of you, and go, yeah, that's it. You reinforce the idea and off you go. And then it happens again, and all you do is just go round in circles, and you get more and more frustrated, more and more annoyed, with no results to even show for it. Worse results. You're like, I've tried everything. I moved my stop. I did this, I did that. But because you made an emotional adjustment, or you're reacting emotionally as opposed to strategic, sitting down, going through your process of how to change your business model. I always use this example of, let's imagine a bricks and mortar garage, right? Service. There you go. As a used car garage, right? As a used car garage, and he's selling supercars, right? He's selling supercars, and he's got some nice cars in there. He's got McLaren, he's got Ferrari, he's got Lamborghinis, he's got Mercedes G wagons, whatever the supercar you're thinking of there. And all of a sudden he goes, oh, you know what? I've not sold any for a while. You know what I'll do? I'll start selling 3 grand motors. I'll start selling little runabouts for people, Fiestas and Ford Focuses and all this type of stuff. That'll do well. And he starts putting those in. And he's not thinking. He goes out to auction and buys a load, brings them back, and he sticks them in his forecourt next to the nice 250 grand vehicles. That's an emotional reaction, and it's never going to work, right? You and I both know that. I mean, do you into cars or not? If you're there in the market for a £250,000 hypercar sports car and it's sitting next to the guy selling a Ford Fiesta for 3 grand, nothing wrong with a Ford Fiesta for 3 grand, does its job very well for 3 grand, but you get the point. It's like, they really, mate, want to buy it. And it's an emotional reaction this guy's done because his sales have not been where they should be, or he thought they should be, as opposed to sitting down where he would have sat down and gone, hang on a second, why am I not selling these cars? The answer isn't to just bring in a completely different business model and bring in runabouts that may well work, but actually I need to think very carefully about this. It might be a marketing thing, might be a pricing thing. You get the point, right? He goes through, and that's what it is with trading. We've got to treat trading like that, be strategic, and not just make an impulsive decision that actually is going to ruin the business that we've built, or the methodology that we've built. And recognize when you're adjusting for the right reasons. You don't want to be the supercar dealer that panics and buys in a load of old cars because he thinks, oh, I need some money quick. You want to be strategic and think carefully about how you're going to make adjustments. Okay, so talk about this rule versus judgment framework, right? And what I mean by this is, how do we know when to adapt? How do we know when to hold firm? So we should have these clear rules, right? There's non-negotiable, what I call red line rules. Your risk, how much you're risking per day, per week, per month, per trade, however you like to frame it. I think it's fair that you can adjust. I don't mind people saying, hey, I use different ways of doing it, use a week risk or a month risk, or that's fine. But that should be non-negotiable, because at no point has any hedge fund manager, as any top trader gone, oh, I'll just risk a bit more than I said I was going to. No. That's such a line in the sand that they don't do. Now, let me just be clear on this. If there's a conscious decision, hey, something's coming up, I want to allocate more risk capital to it, fine. But again, it's a clear, calm, judgment-based decision. But generally speaking, your red lines are, hey, that's how much risk I've got. This is where my stops are. No, non-negotiable, right? Non-negotiable, because those are things that can do damage. You start changing that stuff on the fly, you start moving stops, any of that nonsense, that ends in tears. But there are areas where you can adapt, right? And you kind of go, well, what is in the judgment section and what is in the rules section, fixed rules section? So maybe if the volatility shifts intraday, maybe the conditions shift, and this adaptation may not be in the heat of the moment. There might be some, and we'll get to kind of the differences in a bit, but it might be, hey, I can make a little bit more active decision making because, hey, the volatility has been kicking off for the past few days. I want to extend my price targets based on my plan. I normally take it at 50 points. You know what? I can stretch it to 75 now because the vol is really increased, and that makes more sense. I'm calibrating conditions, and actually maybe I need to use an ATR based target. You get the idea, and you're adjusting based on what's in front of you at the time. So, top traders, remember this, top traders separate the fixed rules from the flexible decisions. The pie should be full of fixed rules as a beginner, and as you become more experienced, the pie chart shifts a little bit, and you get this slither where you can make some adjustments, make some changes based on what you're seeing at the moment, and are able to adapt. Okay, so how do you do this? How do you stay flexible without second guessing every trade? So we talked about overthinking before, hesitation, leading to missed opportunities. But one sort of run through to do, and you can come up with your own, but have like a 3-step process where you say, hey, listen, I'm making, and this is why I say this and why I put this slide up, is that, again, we don't want to fall into the trap where we're making adjustments based on the chimp brain going, oh, well, I should trade a bit more size here. I should widen the stop. I remember that webinar, that guy said, Mark said we should be a bit more flexible. Well, I'm entitled to do this. No. And that might happen. You might make on the fly decisions that you could justify by, well, I'm supposed to be flexible. So we kind of want to head that off before it becomes a problem by saying, okay, is this adjustment based on facts and logic, or is it emotion? And you can be honest with yourself. And again, I'm a big fan of kind of auditing your emotions and being very, very self-aware from that perspective as a trader. Does this align with my plan, or am I just suddenly going off piste and starting to sell, £3,000 cars when I'm selling supercars, right? Am I making this change from an emotional perspective? And it's not easy always to recognize that, but that's something a skill to develop as a trader anyway, regardless of whether it's in this perspective or anything else. Being self-aware enough to say, you know what, I'm a little bit annoyed today. I took a few losers. I need to be mindful that if I take another loser straight off the bat, I need to be done for the day. Or you know what, I need to scale stuff down a touch because I'm a little bit, you know what, I'm a little bit eager. I've had a really good run and I just feel invincible. I can feel it creeping in. You get the idea. Those are two extremes, but always auditing and kind of analyzing how your emotions are affecting your decisions, because we're human beings. They're going to, right? We don't want them to have too much influence and pollute the decision. We want to be making a clear decision and recognize there's some emotion always in there. There's always going to be something. But if it's a little sprinkling, it's no problem. If it starts to be really, really heavily mixed in, that's when we're going to make poor decisions. And train yourself to trust those well-timed decisions. And this is something that I don't think anyone else talks about this type of stuff. Maybe they do. But I like to frame it in a really different way. Many people, I imagine like intuition is kind of, is bobbing his head up out of the water, right? You got a beach ball, yeah, and it bobs up out of the water and you can kind of push it down, it comes back up, push it down, comes back. If you're constantly pushing down your intuition and you're constantly pushing lower, that becomes tough, right? You kind of try to push down this beach ball under the water and it just won't, it kind of pops out. It's trying to it does everything it can to come up. And if you're constantly doing that, that becomes a very, very difficult way to trade. And when it does suddenly pop up, you're like, it just pings off and goes everywhere, right? But think about this from an intuition perspective. If you're constantly pushing it down and saying, no, I'm sticking to the plan, I'm sticking to the rules, which you should do, of course. But if you've got that flexibility, I like to harness it and let it make a little bit of a decision and see if you can trust it, right? And see if you can say, you know what? This part of the trade, I'll leave up to you whether you decide to pull the trigger or not. Off you go, and you give it some freedom. So it's got some barriers and kind of shackles, if you like, not shackles, wrong word. It's got some structure to how the decision's made. Hey, I'm seeing price rip to highs. I'm seeing this bull flag. Okay, now off you go. You, as the trader, has the discretion to take the trade or not, to take the trade on the dip below the low of the flag or wait for the breakout. You've got some flexibility, right? The structure's there, risk is there. Everything's kind of, we're not shooting from the seat of our pants and going, oh, I think it's going higher, click. There's a framework, but now you've got some intuitive and judgment that you can do on the fly. And that is how you harness it. And you start to log it and you say, you know what? I didn't buy that flag because I just felt the time of day was a bit late. We're a bit stretched. And actually, I was right because it just rolled over. It just one of those flags that just kind of petered back over. We were back at VWAP. Or whatever it might be. And if you trust your judgment and trust your intuition and allow it to flourish, it's going to be wrong at times. Of course it is, right? If you've had intuitive nature in your trader, you get it right all the time. Perfect. But you don't. But we don't need to be right all the time. We just need to be right more often than not. And the RVR, the trade has to work out all that other good stuff. So, harness your intuition, learn and not learn, trust it and give it a bit of autonomy. If you're a father or a mother, you know that sometimes your children, when they're very, very young, you have to trust them to make their own mistakes, right? You have to trust them. So they're running, they're running. You know what? They're probably going to fall over that rock there, donk off they go, and it's but they learn then to judge the terrain they're in. And so same with us as traders, like let's not stifle it and push the beach ball down. Let's let it come up and start to note down how effective it is. Use some notes and say, well, I used a bit of intuition here. It didn't serve me. Did. Okay, well, actually, you know what? I can be a little bit more. And what happens is your intuition starts to become more comfortable in making decisions for you. It starts to become a little bit more, okay, well, this guy's allowing me to make decisions. Well, I'm going to prove that I can make some good decisions. And I know it sounds a little bit fluffy in there, but something to think about and maybe kind of process in your own brain after the webinar. So market conditions change, so should you, right? Strategies that work today might fail tomorrow, and that's okay. I'm not saying that we just make massive adjustments, but we need to be able to adjust and adapt. And sometimes tweaking the execution without abandoning the plan completely is the way forward. And I gave an example of this, right? If the market's suddenly super, super volatile, maybe you want to wait for something else before pulling the trigger. Maybe like, hey, I'm getting stopped out and stuff. I like to buy breakouts, momentum ignition type trades. Let you wait for a little bit of a spring contraction before I pull the trigger. And that's a slight subtle adjustment based on conditions. you might go back to a normal ADR, and the ADR starts to compress, the volatility starts to compress, and you go, you know what, I don't need to wait anymore, I can buy the breakout clean straight away. It's a minor adjustment based on the conditions rather than a complete plan overhaul. So this was actually the pie chart that I was kind of picturing over here, making these shapes in the air in front of me. So we want this core strategy doesn't change. We don't want to be flipping around, but we have that adjustment where we make some decisions either on the fly or at the end of the day, end of the week, whenever we make the audit and go, you know what, I was a little, today, or even the day, and then again, the cadence of when you do this is going to be personal, right? If you feel like things aren't just going as they should be, and there's a gut that says, oh, you know what, I probably need to do something. Depends on how active you are as a trader, the style of trade, all this other stuff, right? There's lots of variables that go into it, as always. But you might say, I'm just going to extend the stop a little bit. I'm just going to widen the target a little bit. I'm just going to, whatever the operational consideration might be, and that's that 10% flexibility. And again, you might have a decision on the fly where you go, okay, I have the autonomy I want to buy in this zone, but I have the autonomy to wait, candle close, a candle bid. I have some flexibility there, and I'm going to judge it based on the situation we're in. So keep that core strategy fixed, and then you have that little segment and slither of being able to adapt. And if it's too much, like I said at the beginning, you're going to over-adapt, over-adjust, right? So it's that your strategy should have efficacy and should have edge, but you try to really kind of amplify that edge by having that little 10% where you can make a decision. Okay, so managing drawdowns, when to trust the process versus when to reevaluate. We're going to go into this a lot more depth next week, actually. Kind of market regime shifts, how to adjust and how to kind of do that on a more formal basis. But drawdowns are challenging, right? Because this is when you go, oh, do I adjust? Do I tweak? And in fact, there's a trader I know who, maybe you're on the call, Adam. He was in a drawdown. He was sticking to his strategy. It was working very, very well. Then all of a sudden, he went to a massive drawdown, and it wasn't pleasant at all. But you know what? He stuck with it. He said, you know what? I'm tempted to reduce the size a little bit, and that was I think that was a sensible decision to consider. But actually, he said, you know what? It's sound. It's still sound. The idea is still sound. I just need to make some minor adjustments and stick to the process. And ultimately, that served him. It doesn't always, and this again. Experience helps a lot in trading, and often the name of the game, guys, is to stay in the game as long as possible. That's why I'm always an advocate of just trade small, trade sensible, trade in the game, stay in the game as much as possible to gain the experience that you can do these things and kind of know, I've seen this movie before, I understand what I'm supposed to be doing here. I'm not always going to get it right, but I kind of know things have shifted here. I need to just stop putting good money after bad versus actually, you know what? This is just a normal drawdown. It's just, I don't need to completely tear up the whole rule book here. I just need to be smart. And 5-step review. I'd note some extra notes here. I'm just going to check on my other screen where I put these notes. Yeah, so the 5-step review process. I don't want to clutter up the slides here. So the first one is we want to review a large enough sample size, okay? We don't want to be changing stuff massively after a couple of losers. Yeah, we might say this is unusual. Fine, well, not really. Okay, fine. You've had 15 losers in a row. You might be like, hang on a second, that's a large enough sample size for me to or at least look at it in some more detail. The second thing is, is it an execution error versus a problem with the strategy? Like if you're screwing up by not following the rules or not following the strategy, then you need to deal with that, right? You can't be blaming the system if you're late to the fill, if you're second guessing the stop, all that type of stuff. And that's a discipline issue and something, separate altogether. And number 3 is like analyzing the context. So did the conditions change? And sometimes it's obvious, right? It's like, wow, conditions have changed. I was buying dips. It was working very well. Now we are in heavy drawdown. Or the market is in, much more of a bearish condition. Maybe I need to just shelve that for now and wait till we kind of push back up. If we do push back up in the short term before I start executing that. And sometimes that's obvious, right? Fourth thing is RVR and win rate aligned? Am I is it not working because the win rate is too low, the risk order ratio doesn't work, and we've always got that probability of success versus how much we make when things are right, the game we're trying to play to get what other traders call, I think Lance calls this positive expectancy. We want the win rate good, but we also want the RVR high. Now, you can adjust this, and sometimes the win rate can be below 50%, but if the RVR is really high, it works. You get the idea. You understand how that balance how that sort of seesaw plays out. And then we make small data-driven adjustments. So we look at the data and go, you know what, I'm in drawdown, things aren't working. Do I need to make a big shift or not? Or can I just adjust a few little tweaks? So let's talk about a mental shift of elite traders. Last couple of slides here. Balancing control and adaptability. So what separates disciplined traders from those who are stuck in the ways? It's that growth mindset approach to discipline by saying, hey, listen, you know, I can never have this perfect. I can never drive this car perfectly on a bad analogy because you can in a car, but I can never have this equity curve that's perfectly smooth, right? And I'm going to have drawdowns. I'm going to have times when trades just don't go my way, whether that's because the system has suddenly stopped working, or whether because the market regime shifted, or whether that's because the natural flow of drawdown. It's going to happen, right? But understanding that, you know, as an elite trader or becoming an elite trader, recognizing this is something to work on. It's like there is this trading discipline element of, you know, it's never going to be perfect. I can't be completely strict about it. I need to kind of, you know, have a little bit of flexibility. What can I learn from the past trades? You know, do I need to overcorrect? Examples, poker, right? I'm not big. I've played poker for many years, but if you are at a table with experienced poker players and you only play really good hands, they'll smell you out a mile away, right? You what do they call it? Playing tight, I think it is. You know, if you're only playing pocket aces, kings, suited, any good cards you get, then everyone knows that you're folding rubbish cards, and you're always going to have a good card. So when the flop comes out, they go, well, actually, and so you can't win like that. You have to sometimes play a hand that is a little bit lucky. Maybe you call and you kind of get, you know, it doesn't cost much to call and you just want to see the flop, it comes out and you pick up something decent and then you can play that. So trading's a little bit like that, right? It's not always so clear cut. You can't always just be strict. You can't always have exactly what you want all the time. So think about creating a kind of pre-market plan where you go, right, and this is where we go back to some of the operational considerations. What's fixed? My risk limits, my key setups, my overarching strategy and methodology is fixed, and what's adjustable, right? And I say market conditions, news, catalysts, these are things that create the adjustments, but adjustments you might make are examples I gave earlier. You know, I might be able to trade within that zone. I might be able to go on the bar close or intra-bar. I have some flexibility, but if you define the flexibility before the trading day, this is the trap that a lot of traders fall into. They don't define where the flexibility is going to come in, and they say, well, you know what, I'm just going to buy this low here because I can be flexible. No. Stick to the framework you've got, but also be very clear on the flexibility you're allowed to sprinkle in to that trade. And that might be a little bit, might be like, hey, I have to trade this bar close or intra bar, and it's a 5-minute bar. Not much flexibility there. It might be a range where you go, hey, hang on a second. If we get to this level, I want to buy. Now I can buy on the low as we come through it, or I can buy as we reverse back through it, or I can buy as we kind of do a double bottom. I've got some different ways to adjust and adapt based on the time of day. This pattern's happening based on the speed. This pattern has unfolded. All the kind of things that you take and assess as a trader. So training yourself to adapt in real time. So you want to be able to develop this situation awareness. You don't want to hesitate. You don't want to overdo it as well. But it's just reviewing the past trades. I know it sounds simple, but it's just reviewing the past trade and saying, hey, could I have been flexible there? And would that have served me? And it's a simple question. And again, with any review of past trades, you've got to not allow hindsight to become, to have an impact on your decision, right? You have to be honest with yourself and say, you know what, maybe if I had waited, maybe if I hadn't have been so fixed and desperate to take the trade, it would have served me. And again, it's just review stuff, guys. Okay, the balance between discipline and flexibility in trade execution. So think about this triangle, right? You've got your pre-market plans, you know what you're going to do, real-time awareness, post-trade review. If you can do all that stuff without becoming too much of a robot, that's when you'll start getting the results. You know what you're going to do and have a roadmap for the trading day, a playbook for the day or a playbook for the week, whatever you trade. You adjust slightly, and that might be no adjustment. It doesn't always need to be adjustment, but maybe you do adjust. You adjust slightly on the fly based on the adjustment window you're allowed, And then you review the trades and say, hey, did that adjustment serve me or not? Do I need to be more flexible, less flexible, allow more intuition in, less intuition? Is it serving me? Is it not? And if you keep going around, it should be a circle, I suppose. But if you keep going through this, you end up improving and knowing how much intuition to use, what conditions to allow the intuition to come in, the flexibility should come in, when you should be fixed and when you should be absolutely rigid. You kind of know what's right for you as a person and the personality you are. And it's important to kind of do that. So final thing here is think about the if then approach, right? Instead of reacting impulsively, use this and say, hey, if this price rejects the level, then I will look for some way to get into the trade. And this is how I think about stuff a lot. It's like, okay, if we get a final flush on Tesla that has high volume, high intraday range under some key levels, I will find a way to get long. I'm using a rough example here, I'm not calling anything out particularly, but that will allow me to maybe wait for a double bottom, a second test of that level, maybe a hold above VWAP intraday, maybe a kind of ignition bar straight off the lows, maybe even on the exhaustion if I think I'm reading it right. So there's some flexibility there, but I've got a structure to go with. So that might, how that might look for you is, hey, I trade USD JPY and I want to kind of try and get long, but if it comes back to this level, then I'll give myself flexibility to get long. So you get the idea. It's kind of coming up with this broad framework, so you're not just going long, going short, just trading randomly, but you're also giving yourself a little bit of autonomy to trade, be flexible and adapt to what the conditions are in. For example, that Tesla might be, hey, market might go down, just rip off. Once you do a V-shaped reversal, and you're saying, well, I only wait for a double bottom, and I need to see it flush, I need to see it revisit, I'm taking the trade. You end up missing most of the stuff. Whereas if you have some flexibility and say, you know what, once it's done that, I can get in as I want. But you're also fully aware as a trader, if you're paying up after it's bid off the lows and ripped off the highs, you have to adjust again. You go, well, I'm paying up for this. I'm going to have a wider stop with this. So adjust my position size to suit. Does that still stack up the trade? And that's the decision you have to make on the fly versus, hey, it's come back. It's a wick back below the low. Now I've seen strength in the ignition bar. There's my stop. Okay, I can be a little bit more heavy on this. I can add on this. You can structure it differently. The whole idea is still the same. If it doesn't happen, you don't trade it. But you can kind of be flexible and adapt based on what the market is giving you at the time, as opposed to saying, I'm only waiting for this double bottom, and it just rips off and you miss the trade that you wanted. Okay, so a reminder, if you haven't got this yet, you can download, make a copy of my discipline tracker that I had built. It's a Google Sheets template. You can copy it. And if you're trying to improve your discipline, if you're trying to track stuff, I always like to mention this because I know many of you get so much value from this and you thank me for giving it away. So it's there. You can download that. Just go to the website and somewhere on there's a link. Just stick your email address in and I'll send it to you. Okay. Key takeaways before we do some Q&A. Discipline's essential, but obviously being too fixed can limit what you're doing and how you kind of move forward in trading. The key is to balance rules versus judgment, know when to hold, when to adjust, when to make the minor adjustments, when to kind of make big adjustments. We need to understand the difference between the strategic adjustments and the emotional reactions. And one of the things I think is important is to do the adjustments or any, I'd say major, never really want that much, but any big shifts in the kind of filter, if you like, should be done after the market close when you're cool and you're calm, you don't have the burden of performance on your shoulders, versus the small adjustments intraday, which you should already have planned in. So the plan is still the plan. You stick to the plan, but there is some flexibility within the plan. That makes sense. Okay. And exactly what I said there. Flexibility works best when it's planned and it's not impulsive. Okay, so action plan for tomorrow if you wish. Identify one area where you may be too rigid or too reactive. Define your fixed rules versus areas where judgment might be needed. Use that 90% rule, the pie chart, remember. Stick to the core foundation and methodology whilst having some adjustment. And it's worth spending some time on this. I know many of you are coming and go and go, fine, but it's worth thinking about it because I think if you're an experienced trader, you have some screen time under your belt, this will serve you. And then implement that if-then approach or filter trigger approach to handling the market changes, right? So A is my framework for the day, but I've got some flexibility of how I'm going to get into the trade. Example, I'll give you another example because hopefully this makes sense. You want to get long on the day. You think that, hey, we're going to kind of push off. And you give yourself a few ideas like, hey, I'll take the opening range breakout. I'll take a pullback to VWAP. I think we're going to close at highs today. So you give yourself, that's like a really flexible, but you're aligning long. Like, I think we're going long. I think we're going to get a bid on this because of the daily chart, but I'm going to either take the ORB, pull back to VWAP or a power hour drive or an afternoon breakout, whatever it is. And you have some structure there, but you're still kind of got a focus of what you're actually looking for. So as we go to the questions, let me remind you, ladies and gentlemen, traders, that we are in week 3 of this 4-week marathon of beautiful content for you. Traders Playbook, finding, refining, and executing your edge. We had those last 2. Don't need to repeat them here. Discipline Dilemma today, and next week, same time, same place. We're talking about adapting to market regime shifts. Very apt with what's going on at the moment. Staying flexible without losing your edge. So it's taking it one step further, right? How do we kind of know? We never know, but what's the best practices that I think are the best practices of when we need to make an adjustment, when we need to shelve something, or we need to dust off the old playbook from then and say, yes, it's time to do that, versus it's a short term, let me stick to the rules, let me stick to the plan I've got. Okay, so keep an eye out your inbox for that. Ladies and gentlemen, thank you so much. I will take a little sip of water while I answer any of your questions. If you have any, great. If you don't, then that's fine too. It works for me either way. Peter said, couldn't agree more, rigid rules. Hang on, let me click that. I know, Peter, you might have said that and switched and baited me. Couldn't agree more, the rigid rules pre-discipline, the more flexible rules post-discipline. Yep. Thank you, Peter. Armin. Great webinar as always. Hi, Armin. How you doing? Good to see you, pal. Question related to don't tweak your strategy because of short-term losses. I'm trying to dig deeper here to understand. So much depends on context. It does, and we'll dig deeper into this next week a lot more. What is the appropriate circumstance to tweak strategy and not be late in doing so? Context can change abruptly. By the time I'm comfortable with the new one, it changes again. I'm improving in anticipating a change, but still work to do. Do you know what? I think, Armin, and obviously I know you're trading, it's one of the hardest things in trading when you get to the intermediate level is knowing when to adjust and adapt and trying to change your playbook and change what's been working for you because you're reluctant to give it up. But I would say just trust a little bit, trust. And you mentioned there anticipating a change. I think that's the key. It's like things just feel different, right? When we had this sell-off, it just felt a little bit different, right? Things were a little bit heavier. You didn't really get a bounce, and it was like, maybe I need to be a little bit calmer. Maybe take a few stabs at lows at stuff, and you go, you know what? Things aren't quite the same. I need to maybe be a bit more aggressive with my shorts. And I think it's just a process, and we'll talk about this more and kind of coming up with a more formal plan for you. But it's difficult, and there isn't really a key answer. It'd be perfect if we could constantly be, adjust and adapt and get it right every time. Gary says, makes sense not applying strategy too robotically, discipline, but also taking account context into when it matters. Gary, 100%, and that's I think I'm so convinced that is the key for many traders who do very, very well. Is they have the frameworks that are time tested and quality, buying dips, mean reversion stuff, trend trading, volatility breakouts, momentum ignitions, but they're able to adapt to the conditions and trust the judgment. But at the same time, the intuition knowing that it's still a numbers game instead of probabilities game. So even though the intuition might say, I want to go long, I want to do this, I want to do that, they might say, well, I still could lose the trade. So I still need to make sure my risk is defined. Rob says, how to deal with Trump's noise in the market when the market overreacts to some comments or posts. The chart moves and signal becomes erratic for a while for the rest of the day. How long do you wait out before you start trusting your chart signals again? Do you know what, Rob? This is a very, apt question to say, to ask in the current conditions and environment. I think you've got to, stuff's getting a little bit more muted. I say that now, it's going to come out with something crazy going to go, well, I think it's going to be a little more muted in that you have the initial reaction, the algos go crazy, then it kind of settles back in. And so I think that, I don't know what time frame you're trading on. I think that just starting to go back, and something I did quite a lot of this before kind of Trump starts coming to office, actually, looking at seeing how the market reacted to the specific tweets. I was looking for edge, and I didn't actually find anything that I thought had decent efficacy. But you start to see that the reactions start to get a bit more muted over time, and so you can then say, well, you know what? I need to allow for it. I need to have a stop in place for it. I need to manage the risk because that's the number one rule. I don't want Trump coming out and saying something and wiping out all my gains for the month because I wasn't aware or I would never. So I think being extra mindful of that is key. But then, it settles out. And if it's a genuine reprice scenario, then obviously you need to adjust and adapt and allow that into your plan. If your plan says, hey, if the fundamental driver of this is one direction, I need to align with that direction. Now, if Trump comes out, and that's the one thing that's happening at the moment, that shifts that fundamental driver 180, and you need to be mindful of it and go, oh, you know what? I was quite bullish on Canada. Now Trump said this, that changes the game. Okay, I need to watch out. Example could be, even though Tesla's a bit more beaten down, imagine Tesla was at highs and we had the BYD news that said electric cars, we can charge them in 5 minutes now. Sales are really, really awful in Tesla. That's a potential fundamental shift. And so then you go, my plan says when I have something that fundamentally changes the valuation of that asset, I need to take it into account. Then obviously you adjust and adapt. Okay. I think that's it, ladies and gents. Dennis just says, thanks, Mark. Always awesome. Your content helps reinforce second takes on erratic market conditions and remaining on track with process with adaptability. Thank you, Dennis. I appreciate that. And I appreciate you all. Guys, thank you for turning up. Thank you for sitting here and listening to me talk about something that I know is quite niche. It's quite, but it's super important. If you want to kind of get it to the next level, kick things up a gear, then I think it's an important skill to master. So appreciate you all. Thank you so much for coming, and I will be back again same time, same place next week. Now, where is this button? I know it's here somewhere. See you later, guys. Bye-bye.